Good morning. On behalf of the NYSAC President Jack Marin and our Executive Director Stephen Aquario, I want to thank you for joining us this morning for a webinar entitled Better Understanding Your County's Financial Position in 2021. My name is Mark Levine and I am the Deputy Director of your New York State Association of Counties, and it's an honor to be moderating this panel this morning. COVID-19 has left its mark in 2020, in the beginning of 2021, and its impact on your county's liquidity position is likely to last well into the future. New data opportunities allow your county to explore how you might be able to of taxpayer dollars after COVID-19 using liquidity analysis. This webinar will focus on how counties can get a clearer picture of your cash liquidity needs, how to use this data to create concise reports for internal and external stakeholders, and how to leverage that knowledge to generate additional revenue. Wayne County Treasurer Patrick Schmidt will provide a case study sharing how their liquidity needs have shifted over the years that they have been working with 3+1 and how they have been using liquidity data. And we had a little conversation ahead of this webinar, and I think you'll be blown away by the numbers that Patrick will be sharing with you today. In case you haven't noticed, NYSAC has been active in providing educational opportunities with 3+1 so far in 2021. We're doing that because we want to give counties an opportunity to leverage as many benefits as possible with the tools that come along with working with them. It's already January 14th. Time is flying by. That means you have 351 days left in the year to manage your county's various bank accounts. If we, through these opportunities, can help your county generate additional non-tax revenue on your existing assets, that's a win for the county and a win for our taxpayers. This morning, all attendees are on mute. If you have a question, and we encourage questions, please submit them into the question panel of your webinar panel on the right side. It's on my right side of my screen anyway. And after the panelists are done speaking, we will take up all those questions. Again, thank you for spending an hour with us this morning, taking your time to be with us to learn about how we can help you manage your cash position in 2021. At this time, it is my pleasure to introduce our two speakers, and I want to thank them for joining us this morning. The first, Alex DeRosa, is a relationship specialist with 3+1. Alex first joined 3+1 in 2015 as an analyst intern. His passion for serving the public sector was ignited by a previous internship experience at the Department of Commerce in Washington, D.C. Alex would go on to graduate summa cum laude from St. John Fisher College right here in New York with a degree in economics and later complete a master's in public administration from Marist College. Prior to joining 3+1 full-time, Alex worked in healthcare analytics for a major health insurer. Since rejoining 3+1 in early 2018, Alex has been using data and analytics to help public entities maximize the value of their financial resources and evaluate their relationships with financial providers. Alex and his wife reside in Buffalo, where they were both born and raised. Go Bills! Patrick Schmidt is the Wayne County Treasurer. Patrick started working in government finance in 2013 when he was hired as the Wayne County Internal Auditor. He was elected County Treasurer and started his first term in office in 2019. Patrick has a bachelor's in accounting from St. Bonaventure University and a master's in business administration from Southern New Hampshire University. Patrick has a wide range of accounting experience from audit to income tax, beginning with his years working at a public accounting firm prior to working for Wayne County. Patrick's roots in public service stretch back to 2003 when he became a volunteer firefighter. Thank you for your service, Patrick. He has served in various roles at the fire department, including deputy treasurer, department treasurer, captain, deputy chief. Patrick currently serves as vice president of his department. Patrick and his wife were both born and raised in Wayne County and agreed it was the best place to raise their 2 children. Thank you, Alex, and thank you, Patrick, for joining us. At this time, I would like to turn this over to Alex DeRosa.
Thank you so much, Mark. And before I get started, I just have to say, because I know a few of my bosses are listening, I did not add in that "Go Bills" at the end, but I thought about it, and I thank you for saying it for everybody to hear it. It's the one thing that everybody in Buffalo is thinking about all week. I can't thank Mark and Jeanette and NISAC enough for giving us the opportunity to share our story via these webinars each week, because in a time when we're all missing being able to get together and work together, finding these virtual tools to make sure that we're still able to collaborate and learn from each other is really what's going to help us navigate 2021 before we can return to a state of normalcy. What we're going to be talking about today is focused on getting a financial picture for your county in New York State. In my role at 3+1, I'm lucky enough to work with counties, cities, school districts, and other municipalities around the state and around the country to show them their financial picture and also learn from them about the stories they can tell me that explain a little bit more about that picture. For counties this year, there have been plenty of changes that are going to make your picture look a little bit different than they have in the past. Some of the easy, quick ones that come to mind, of course, are sales tax. There were certain points during this year where I know all of us were expecting sales tax decreases in the double digits, if not as high as 20–30%. And to this point, that hasn't materialized, which is fantastic news. But there are still some significant shifts, certainly to be expected not only in 2021, but potentially beyond that point. Another shift in your financial picture would be state aid and any dollars that your entity anticipates receiving from New York State. We've seen delayed payments and cuts in payments across the board, and we're not always sure how long that might continue or if there could be additional funding on the way to make up some of those gaps. But surely that's having an effect on every single county in New York State. Most counties that I work with were not able to have their tax foreclosure property auctions this year. That's something else that can drastically change your liquidity position. And another example would be Social Security payments. As we know, that fourth quarter payment was delayed by New York State and says it's not owed until 2021 and 2022. So those are just a couple quick examples of how COVID-19 has shifted counties' liquidity positions in New York State in a real way, and why now is a great time to get a financial checkup, as we like to call it, and get a clear look at what your picture is going to look like going into 2021 and beyond. The learning objectives that you'll see on the slide just go over some of the things we hope to achieve today. I think it's very easy to see why investigating the impacts of an economic shock on your county's liquidity position is so important right now, based on a few of the things I just mentioned. We're seeing shifts and changes that we haven't seen at any other point in recent history, and it's important that we see how these things are going to be affecting your county's financial resources. We want to talk a little bit about our ability to forecast liquidity, to plan for different scenarios in 2021. It's something we tried to work through as much as possible in 2020 with so many uncertainties. And really the only way to try to plan through those uncertainties is by having a forecast that you can build off of and identify where there are differences from what you expected and try to identify the cause of those differences so we can anticipate any further changes. We always want to be evaluating our financial partners at the county level, just to ensure that as the marketplace changes, the value we're receiving for taxpayer dollars is still being maximized. That's something that needs to be reviewed at minimum quarterly, but potentially as frequently as every month. This year, 2020, had some of the most drastic marketplace changes that we'll likely ever see. And there's no reason to expect 2021 to be any different. We're expecting changes to happen very quickly with the amount of actions that are going to be taking place both at the state level and the federal level. And lastly, most importantly, anything that we can do to help counties share their financial picture with their stakeholders and their taxpayers. That's the most important thing that we feel a county is able to do, is share your story so your constituents know you're doing everything you possibly can to consistently maximize those financial resources. On the next slide, I wanted to start with a couple quick, easy examples of why liquidity is so important for New York State counties. This example shows a quick snippet from Fitch Ratings. I'm not going to do much reading during this presentation, but I'm just going to read this highlighted portion really quick so we all really understand the power of liquidity for Fitch in this situation. Cash management tools are not typically the focus of Fitch's analysis of U.S. local governments, as liquidity is sufficient for operating needs for nearly all issuers through cyclical downturns. However, given the uncertain nature of the coronavirus pandemic and the depth and duration of its impact on the economy, Fitch believes many local governments may explore extraordinary cash flow support measures in the near term, particularly those governments that do not carry large liquidity balances relative to operating needs. So what does this mean for New York State counties? As you all know, Fitch Ratings and other rating agencies across the country are going to be rating your county's financial picture, your financial health, so that so anytime the county goes out to borrow funds, you all can see what your rating is, and anyone who's looking to invest in those county funds can see what Fitch rates your county's financial health as. The liquidity is becoming more and more important in these rating processes because Fitch sees the importance of the changes that have happened during the coronavirus pandemic over the past 8 months. The next slide shows another example from the Municipal Securities Rulemaking Board. And in this situation, the MSRB is showing us that liquidity, and specifically a third-party liquidity support provider, is one way to enhance your credit rating so that investors can be more confident in your county's financial picture. These are things that can result in real dollar savings for New York State counties if you're able to supply your investors with some additional liquidity data that's able to show them we're paying attention to our liquidity, we're maximizing the value of our liquidity, and we're prepared for whatever comes next. The municipal debt market is expected to be much more active this year because, as we know, rates are far lower. The cost of borrowing for counties in New York State is going to be lower this year than it has been in years past because of those lower rates. By using liquidity data to support your county's case for having a strong financial picture, you're going to be able to create additional savings on those borrowing costs. The next slide starts to go into the conversation that we need to understand to get into some deeper conversations on data. And that's what's the difference between liquidity and cash flow. Today, we're going to be talking a lot about liquidity, but we can never get a full grasp of a financial picture without cash flow as well. The easiest way to describe this is liquidity is what your bank is seeing, what the marketplace is seeing. And cash flow is typically what you at the county are seeing through your general ledger and through your budgets and your audits. This is a very, very important distinction because liquidity deals with the actual dollars that are available to you on any given day, whereas cash flow doesn't necessarily follow where those dollars are at any specific point in time. An easy example, of course, is when a check is sent out by the county. In the county's eyes and in the general ledger, those dollars are gone. But in the bank's eyes, those dollars aren't gone until someone else cashes that check and it clears. And those dollars in between that time are still being collateralized by the bank, potentially still earning interest. When we're able to understand the difference between liquidity and cash flow and bring that picture together, we're able to maximize financial resources continually and also identify any differences that may occur between the two. And I really couldn't think of a better person to speak on that just briefly than guest speaker Patrick Schmidt from Wayne County. Patrick was previously the auditor for Wayne County and now holds the position of treasurer. So he's really gotten to experience both sides of that coin. And I thought it would be great if Patrick could just share quickly how he felt transitioning from that auditor role to treasurer role, where your focus moves more from financial statements to what's available in the bank today. Patrick, could you share a little bit about your transition into that treasurer role over the past few years?
Certainly, Alex. You know, it was quite a big transition because you, as the auditor, when you're looking at bills and expenses going out, the money's gone at that point. So you don't really think about how are you going to manage to make sure that there's always cash in the bank to pay the bills. So it's quite different. I'm just the auditor seeing, yep, the bill's approved, it's out the door, it's gone. On the treasurer side, you're saying, okay, where's the money coming in to offset that? So really managing the liquidity has been a big transition for me.
Thanks, Patrick. I mean, it's something I think about all the time because I was an accounting student in school and I truly didn't understand that difference between treasury services, treasury data, and accounting, general ledger data, general ledger information until I got to experience working in the banking industry and in treasury services. And in the county spectrum, there aren't necessarily a lot of stakeholders who get to be in both of those places like Patrick has. In most cases, what's seen on audits and budgets through the general ledger is the financial picture that public entities have of themselves. But it's so important to focus on the actual cash, the liquidity that's available at different points during the year, because that truly shows the health of your entity and what might be changing both in the past and going forward. So one way that we try to identify those differences of what's changing and what is available is, of course, looking at data. That question, what is data, is so important today, and it's getting more difficult each year to answer. I know at the turn of the century, we were calling it the information age because we understood with the internet coming around, the amount of information available to everybody was just incredible. And it was going to be so useful in our decision-making processes into the future. Today, in 2020 and 2021, actually, I think we might be entering an over-information age. Data is everywhere. It is surrounded by us in sporting events, investing activities, obviously anything to do with finance at a New York State county. But with all of this data available to us from our banks, our accounting software providers, exterior financial partners, the real challenge is finding actionable data that can help us make decisions and evaluate what's occurred in the past. When we're able to focus on key actionable data points, that gives everyone flexibility to feel very confident that they're maximizing financial resources. And that's something we focus on at 3+1 continually. We know there's so much data available to county officials, and it can be very difficult to get a clear picture of what's going on. So working with counties, listening to what needs they have is the best way for us to try to identify really what are the most meaningful data points for you and your entity. And that's not going to be the same for everyone. A couple examples of that data are shown on the slide there, where we're looking at a specific point in time. In this situation, it was a specific quarter, October, November, December of 2019, compared to October, November, December of 2020. For this specific public entity, you can see their liquidity position actually increased significantly between those 2 years. That's something that we're continually looking at 3+1 is the same segments of time in different years to make sure we're picking up on any new patterns, any changes that your county may experience based on some specific factors like I talked about earlier in the presentation maybe related to sales tax revenues or distributions of those sales tax revenues to any municipalities within the county. There's always going to be a story to back up the data that we're seeing. And that's what I love about my job, getting to work with these counties, is showing a county that data picture and then learning from their story as to what might have caused this. And it can be a lot easier to tell that story when we're able to dig into the data and identify very specific points in time, sometimes as little as a specific week of the year where we see a significant change and say something about this payment or this receipt must have changed year over year because we're seeing major changes. On the next slide, I'm going to turn it over to Patrick just to give a brief introduction to Wayne County and share some of the stories that he has about using this liquidity data to have a clear picture of Wayne County's finances.
Thank you, Alex. As everyone knows, Wayne County, as you can see on the map, is located between Rochester and Syracuse. We have a population of about 90,000 people. We are a very rural community. Agriculture, apples, as you can see from our logo, is our big production. We run a county nursing home that has been talked about, as everyone knows. People say, sell your nursing home, keep your nursing home. We've opted to keep it, and we've almost made it a break-even proposition in our county. All funds budget is 187 million. The general fund's about 150 million of that. And as Mark said earlier, we were talking, and as I started as auditor, I was skeptical of 3+1's program. When they started with us in 2015, I didn't really get the liquidity side of things. How could you turn that into interest income? But for example, prior to 2015, our general fund interest income was approximately $50,000 a year. In 2019, our general fund interest income was $1.4 million a year. And we're closing out, as we close out 2020, we are closing in on, even in a down year, having almost $1 million worth of interest income based on using the liquidity information that 3+1 is providing us to help us manage our investments and make decisions. You could go to the next slide. So this is one of the tables that's in the reports that 3+1 provides me, and it shows the different liquidity levels. And if Alex wants to explain these liquidity levels, I would appreciate it, and how it's formulated and what they do to come up with this.
Absolutely, Patrick. So in this chart, what you're seeing is an incredible amount of data input into some actionable information like I was talking about earlier. So we take every single transaction from a public entity throughout a 12-month period and run through 50,000 simulations of daily balances throughout the year to arrive at what's called time horizon data to show the duration capability of a public entity's cash. So how long is your cash available for? And in turn, what can you do with that cash based on how long it's available for? In this case, you can clearly see when there are 5 liquidity levels, that means this entity has a very strong foundation of cash. And this is the information that Patrick uses to manage Wayne County's liquidity using many different tools. I think that's why Patrick was a great choice as a guest for this webinar, because he really uses this data to the fullest potential by having multiple different tools for the different type of dollars that he's dealing with. That's one of the key messages that I have, is not every dollar is the same. What you do with dollars that are available for 2 to 3 years is going to be very different than what you do with dollars that are available for 1 day or 2 days. And if Patrick, you could share a little bit about how you use this table and those different tools that you have at Wayne County, I think that would be a great way to show counties how this information can be very actionable.
Certainly. So when I look at this chart, when we get it quarterly, I always look at levels 3, 4, and 5. And if you look at the bottom, those are the dollars that are going to be basically, you're not going to need for a whole year to almost 3 years. And that's the level of funding that we put into our long-term investment account. We have an investment advisor that helps us buy permissible investments such as treasuries and state bonds and whatnot. They're always seeing what's coming out, and we build out so that we always have that money coming due, but we put that in a long-term investment saying, we aren't going to need this tomorrow, so let's stretch it out and invest it out for a couple years. Liquidity levels 1 and 2 are the levels and the amount that we try to manage ourselves. We buy CDs and put them in other sorts of short-term investments that we can do ourselves, and we don't need to go out to the open market to really buy. And then the cushion level, the 8.3 million, that's kind of the money that we put into money markets or into items like NICLAS and NILAF that are highly liquid that we can get to. So we start getting in a crunch, and the next day we can get money to cover payroll or cover accounts payable, depending on what's coming in from the state and other funding sources.
I really think the work that Patrick does with this data is truly to the highest level that we intended it at 3+1 because of those different partners and those different tools that he uses. That's our core message that definitely rang true this year in 2020. There's no one tool for all dollars. If Patrick had used short-term money markets or short-term CDs for all of these dollars, the county would have lost an incredible amount of value because of how quickly interest rates fell in 2020. By having the confidence to lock in those dollars in liquidity levels 3, 4, and 5, because Patrick knew these dollars aren't going to be needed in 2020, let's lock in a strong rate. The county is going to continue to have higher interest earnings into the next 2 years because of the investments that have been made at that time. The next slide shows a month-by-month breakdown of some examples that can really help with the dollars that Patrick was talking about, the county managing themselves between CDs and treasuries and any money market accounts or liquid pools that they use. What this chart shows is the largest single day outflow in that first column for a public entity. What's the most amount of cash throughout the month that your county needed just on one day? So did you need $20 million liquid in the bank at any time? When you look at that chart and you see that the largest expenditure, even throughout the whole year, was $10.5 million, the answer to that question is probably no. When you look at that net change in monthly cash on the right side of that column, that shows you on a net basis across all 30 days of a month, what happens to a county's liquidity position. Clearly, we all know, looking at December as being the most negative month, that $11 million decrease in cash position, I think New York State counties would all be able to identify that that's from your retirement payment that comes in December. But Patrick, I thought it would be great if you could just briefly speak about how you might use data like this to ladder out some of those CDs and treasuries that you use in your own self-managed portfolio, where you're only talking about maturities that are maybe 6 to 12 months into the future instead of 2 or 3 years.
Correct, Alex. So, I mean, when we look at this chart, I mean, as every county knows, you get to your February and March timeframe. That's the time where the collections, tax collections are starting to get turned over in our county from the town collectors. So we know that we're going to have a large influx of cash coming in February and March. So in November and December, when we're starting to ladder out short-term investments, we know we can skip over those months because there's going to be money coming in when we look at this chart. I mean, we also know that, in May and in March, historically, we have, large outputs of cash. So we want to make sure we have stuff coming due in February. So we have the cash on hand just in case those large expenditures occur again this year. It also, the single day outflow helps me peg how much I want to keep right in the checking account for that month. I know historically, if I went back a couple of years looking at these, we always have a single day outflow of around 4 million in May. I know I always want to keep 4 million highly liquid for the month of May.
And I think that's one great piece of information everyone can take from this call for what we're looking at in the immediate future for New York State counties. And that's an influx of cash in the next 2 or 3 months towards the end of February and early March. So what can we do today to prepare for that? Start having conversations with your financial providers to see who's offering competitive options, who's going to be interested in those deposits when the county becomes flush with that cash. I know it might seem a little too early to start thinking about it right now because most counties are still at some of their lowest financial positions throughout the year, towards the end of December and early January, but we know how quickly that turns around during tax collection season. And if you don't have those conversations with your financial providers until that money starts to hit the bank, you could be losing out on 2-3 weeks, maybe even a month of value generating opportunities. The next slide shows another great way to prepare for what's ahead. And this is through what we call a short-term cash position forecast. When we're forecasting an entity's liquidity position going forward, it's based on a minimum of 24 months worth of data. But in Wayne County's case, we actually have about 5 years worth of data. So we're able to be very confident when predicting where their liquidity position is going to be in the next few months and identify where any changes might occur. So just like Patrick was talking about, preparing for those influx of tax dollars towards the end of February and March, you can see in this forecast where that blue forecasted line is projecting an increase in balances and then a flattening of balances later into the year as we come into the summer when counties are no longer at their highest cash position, but still have plenty of opportunity to maximize resources continually. A forecast like this is a great tool to identify where there have been significant changes in your liquidity picture. When our forecast is created, it's only looking at numbers. It's looking at the data. To put it one way, the forecast doesn't know that COVID-19 happened. It doesn't know that sales tax receipts where it could have been decreased significantly. It wasn't anticipating that. It was anticipating 2020 to be a similar year to 2019 because that's how forecasts work. So as we continue to forecast out New York State County's liquidity positions, if we start to see significant differences, we're going to know that these are some time periods we want to drill in on and find what's causing this and what might that mean for the future. The good news for most New York State counties is that to this point, we haven't observed significant changes in liquidity positions as a result of COVID-19. We touched on sales tax briefly before, and I'm sure NYSEX sends out plenty of information on that, but sales tax numbers weren't as dismal as we thought they would be, and in many cases, they've gone up for some rural counties in New York State. Had they not had this result, and we did see 15, 20, 30% declines in sales tax revenues, comparing a forecast to what actually happens is the best way to know what effect that's going to have on your liquidity position in the future if those things persist. So that's one way 3+1 is going to continue to monitor not only the general economy, but each county's specific economic situation in 2021 as we're getting through this pandemic, and there are still going to be many factors that could change counties' liquidity positions in the next 12 months. The next slide goes into something that I think Patrick will have another really great insight on, and that's your banking arrangements amid COVID-19. Just as everything changed for every business across the country in March and April, things changed very quickly for banks as well. We saw significant shifts in the interest rate environment. We saw earnings credit rates fall drastically. And we saw banks become flush with deposits through programs like PPP and federal stimulus. All of these things have an effect on New York State counties. And as many counties are going to be working with multiple banks, it's very important to continually evaluate those banks and ensure that your county is receiving appropriate value. The only way to appropriately evaluate different banks is by putting them in the same box for apples to apples comparisons. There are so many things that go into evaluating a banking relationship, whether it be the technology that the bank offers, the servicing that the bank offers you, the location of any branches of that bank, the interest rates they're paying, their earnings credit rates they're giving you, and any fees that they might charge. Patrick was lucky enough to go through a banking RFP process right at the beginning of COVID-19. I know that's got to be unbelievable for many people to hear, but Patrick completed an RFP, I believe it was at the end of February, and then had to start a banking transition right in the middle of March 2020. I can't think of a scarier time to be involved in that. And obviously, that's not what anyone planned for, as COVID came completely out of nowhere. But the process of evaluating different banks is what made Patrick feel confident in selecting a bank that was going to make sure the county was maximizing value continually. Our process at 3+1 is to put banks in an apples to apples comparison, because as many of you know, there will be banks that you work with that say, we don't charge fees, we'll never charge a fee. And there are other banks that say, well, we do charge fees, we track them in the background, but as long as you keep a certain amount of dollars on deposit, you don't need to worry about fees. You won't be facing fees at any point in time. Those are two situations that are very difficult to compare, because one is saying, don't worry, you'll never face fees, and one's saying, oh, you might not. It's something that requires an incredible amount of data and insight on what opportunities are available at each type of bank and what services your county is using. So I thought it'd be great if Patrick could share a brief tidbit about his experiences going through a banking RFP process, where there were certain banks that said specifically, there are no fees, we don't have to worry about being charged fees, and other banks where fees were part of the conversation, but there's so much more that goes into it. Patrick?
Thanks, Alex. Yeah, it was one of those things. I was coming in as the new guy, trying to get to know the banks, learn everything. And one of the things that drove me to do the RFP is I was seeing that a bank may say they don't charge us any fees, but I also noticed the interest rate we got was a lot less than what other people were getting or other municipalities were getting as well. So it led me to believe, there's other stuff in the background. They might not be charging me a fee, but they're reducing the interest that they're giving to the county taxpayers. So that was one of the driving forces that sent me to go out and say, okay, tell me what the interest rate's going to be. Tell me what the fees, if they are going to be, and then let's compare them apple to apple. So giving them an exact example, here's the balance, here's the number of checks, here's the number of wires, ACHs that are going to go out in a month. Tell me what it would cost. How much would I make in interest income from you? And how much would I be paying in fees if that's your structure? So we could compare apples to apples across. We had 6 banks respond. And using, the electronic process that I went through, actually, most banks said it was the most efficient and easiest RFP they've had to respond to.
I think one of the most important things you mentioned there, Patrick, was the data that you used to make sure that these banks were able to respond in a way that you got an apples to apples comparison. It's not easy to pull exactly how many ACHs you issue and checks that are written and where those checks are deposited, but all of those items, along with a whole slew of other things, go into how a bank will propose their services to you and propose their pricing to you. So without that information, you're going to go to a bank and ask for proposals, and it's going to be difficult to compare those banks that don't charge fees to the banks that do, because the bank is just going to be guessing. But when you're able to share this information and both sides are working off the same data, that's when we get those best apples to apples comparisons. Some of those comparisons are shown on the next slide when we're talking about the importance of peer benchmarking. This is just a simple example of some CD rates that were collected during the month of December, all from different banks throughout the state. Clearly, the value of cash is different to different financial providers, especially in today's marketplace. When you see the difference between a bank number 2 and a bank number 5, it's clear that if your county isn't getting an appropriate amount of data on what peer benchmarks for both banks and other counties are, you might be missing out. If you are only working with banks 5, 6, and 7, there's a lot of data, a lot of opportunity being left on the table by not knowing what else is out there. So that's another type of data that can make your county's financial picture stronger each year, is learning what your peers are doing and what's available to you in the marketplace. The next slide is a similar graph to what we looked at with Patrick earlier, and this shows the impacts of benchmarking your cash, not only against your peers, but against what's available in the marketplace. I like the different colors that are shown on this graph because it represents some of the different tools, like Patrick was talking about, he uses to manage different dollars. That blue region are dollars that were placed in fixed income by this entity. The green region are dollars that were placed in high yield, so investment yield, money markets, and liquid pools. And the orange dollars, that orange region, was used for low or no yield checking accounts or dollars that were offsetting banking fees. The point of this graph is to really drive home that no dollar is the same for a New York State county. There are different products for different dollars that you have available for different periods of time. And when we know your county's liquidity picture and the stories behind each of those dollars, what restrictions they might have on them, when you're going to need them, what changes might have occurred over the past 12 months, that's how you can find the best way to maximize value for your county. And that's the ultimate goal of having a clear liquidity management practice. Some of the benefits of liquidity management are just listed on the next slide, where we talk about boosting your credit rating for any debt refinancing that your county might be doing, any forecasts that you're able to do through data collection so that you can anticipate future cash needs and debt needs, the ability to identify all cash as a revenue generating asset to make sure that you are maximizing value for your taxpayers, monitoring your bank fees to make sure that your financial providers are giving your county appropriate value continually throughout the year as the marketplace changes, and most importantly, providing some peace of mind for you and your county stakeholders that even in times of financial stresses, we have data to back us up to show where those opportunities are, what cash is still going to be available no matter what happens in the marketplace. I think that's something that's so incredibly valuable, especially this year after everything that has changed, knowing that there are not always going to be consistent, steady streams of revenue like we're used to in the past. When there are those changes, we're able to identify where they occurred, why they occurred, and if they're likely to occur again in the future. If you don't have access to data and information, those stresses can definitely be overbearing. But when you do have that information to address any concerns you have, it's much easier to have conversations with the right stakeholders upfront. One last quick story I wanted to share that goes into the benefits of liquidity management and the importance of liquidity management is just some recent comptroller audits that we've observed in New York State, specifically focused on liquidity management. This is something new that we haven't seen, but the next slide shows an example of an audit that was completed in the past 12 months, actually in August of 2020, and it was specifically related to this entity's liquidity management practices. Some of the recommendations that the comptroller had for this entity were: we need to develop and manage a comprehensive investment program. We need to prepare monthly cash flow forecasts to estimate available funds for investment and any potential cash needs. And we need to solicit interest rate quotes and obtain investment information from a wide variety of sources to make sure that your county is doing everything that we can to maximize the value of taxpayer dollars. This audit's a little bit different than anything we had seen in the past, but it definitely caught our eye because we want to make sure that every county in New York State is doing each of these things to not only maximize value, but to clearly show their financial picture for their stakeholders continually throughout the year. It's something that I don't think is going to be going away anytime soon, as the comptroller knows that these data opportunities for counties and other entities in New York State exist. They want to make sure that you are taking advantage of everything that's available to you. to truly maximize taxpayer dollars. And that's certainly the goal of the comptroller in this situation. Thank you very much for your time. That concludes the slide portion of this presentation, but I'd love to field any questions that anyone has.
Thank you. Thank you, gentlemen. I just needed a minute here to unmute myself. This is Mark Levine, the Deputy Director of the New York State Association of Counties. I would invite all participants to submit your questions to the question panel on your right side of your webinar screen. The first question we have is from Mary Gates in Ontario County, and it's to Patrick. Patrick, it appears that this is developed using historical data. I think it's one of the first slides or second slide that you talked from. Did you find you were concerned by the major shift in state aid payments we saw this year? So that's one thing, that the liquidity position that counties are facing is it's not only generated or not only a result of the sales and property taxes, but also the revenue generated from aid or reimbursement from the state of New York. So, Patrick, how did you deal with the changes in reimbursement and assistance from the state?
So basically, with knowing that, the state revenue was going to go down, and this is looking at historical data, in my mind, it was, okay, this is what it was last year. I'm probably going to need more going forward. But it still provided me that base knowing, okay, we're, historically, we're spending $8 million in the month of April, for example. Revenues are going down from the state. So I better have maybe 8 to 9 million available to pay bills because the reimbursements are being cut.
Okay, great. What information does my county need to get a financial picture like the one that Patrick had?
So for us at 3+1, we collect every single transaction from every bank account, every investment account that a county has, as well as a budget and an audit. We try to get as much information as possible because we have some powerful technology to handle all of that. Something that a county can do on their own would be looking at either daily balances or monthly balances from their bank accounts and investment accounts, and working off of data like that to try to find specific opportunities throughout the year. Obviously, the more data that we have, the better, but even something as simple as monthly balances at the bank can be a great starting point to looking at your liquidity to maximize those opportunities at different points during the year.
Don't most counties already do this without 3+1, Alex?
I certainly hope so. I think it's such an important piece of what counties are doing because at the end of the day, that treasury management side of the business, that cash and liquidity side, is where the value is generated. When we talk about financial health, I think all of us go to the audits and the budgets, but looking at your liquidity, what's actually in the bank, that's what's readily available to you. That's what you need to make sure is A, sufficient to meet your cash needs, and B, sufficient to maximize value for the taxpayers with anything that you have left over. So to answer your question, I certainly hope it's something that all counties are doing, but what we bring to the table at 3+1 is technology to handle massive amounts of data that I'm assuming many people aren't able to do in a simple Microsoft Excel or other tools like that, because we've tried to do it ourselves at 3+1, and it's a lot easier to teach a computer to do something than it is to enter information yourself into Excel.
Mark, if I could.
Yeah, go ahead.
Just to add on to what Alex said, a lot of people and treasurers and accountants look and say, okay, here's what I spent during the month. It's great that you cut the check, but as Alex said, when did the check clear the bank? Because if you have big vendors that take forever paying, you might cut the check in April, it might not clear till May. So that gives you a little bit of wiggle room. So looking at the bank statement saying how much came in and how much came out during a month as compared to just looking at your income and expenditures on the general ledger. That's another way to manage this and look at it.
Great. Thanks for adding that. So Patrick, you talked about the savings or the interest you've generated, and I think the latest year is approaching $1 million, and last year was 2019 was 1.4. When you add the interest plus the savings for the in your bank fees, have you calculated that that number?
We have not calculated that number yet, but we plan to, just because with COVID, everything slowed down on the banking implementation. It was a longer process than, we would have thought originally. We had a few month process. It dragged on for a few months. So we don't have a good picture yet. That'd be something I'm going to calculate once the new banking relationship is at least a year old.
Okay, great. What are some factors, I think this is for Alex, what are some factors to watch for that could change a county's liquidity patterns for entities, for counties and other entities in 2021?
Great question. So I touched in the beginning of the presentation on some things that did change liquidity positions in 2020. So looking at 2021, of course, the most obvious one is always going to be sales tax. We know our counties rely on sales tax, and I hope that 2020 serves as a foundation of what sales tax will look like in a COVID world where we might have shutdowns in the economy at certain points of time. That being said, the federal stimulus that was passed in 2020 and maybe continued to pass in 21 will certainly play a huge role on many levels for the county's liquidity positions. On the sales tax side, even though the counties might not be getting distributions directly from the federal government or from New York State, if your constituents are getting direct payments, that's certainly going to affect sales tax. And it certainly helped sales tax in 2020. So if we don't see similar stimulus in 2021, or if we do, that certainly is something that we're going to want to monitor for the sales tax side. And then, of course, any aid that could be passed directly to public entities in New York State or directly to New York State and then down to counties in New York State is definitely something that's going to significantly shift liquidity positions. We do work in other states where they did receive aid for counties that were even not in that 500,000 person limit, because aid was passed down to the state and then the state distributed to each county. And we have observed changes in liquidity positions for those entities that did receive funding because of all the changes that they had to implement and this new influx of cash that they were able to use for it. So that's probably one of the biggest things to look out for as we have a new administration coming in that's going to be looking to address the pandemic with their own version, their own stamp of approval, I would say, and their own version of a stimulus package. We don't know what that means for New York State counties yet. When we do find out, I'm sure NYSEC will be the first one to tell us what it means, but that's definitely going to affect liquidity positions throughout 2021.
Well, I can tell you that the the incoming Senate Majority Leader, Charles Schumer, and Senator Gillibrand have said that one of their priorities when the Senate reconvenes and after the inauguration is to provide an additional stimulus package, and part of which would include some direct and flexible funding for states and localities, including county governments. So we are definitely will be looking out for that. I thank you both, gentlemen, for this time that you spent with us and to share your experiences and your solutions with our members. At the beginning, I said that there are some other educational opportunities that we are promoting or providing for counties in January of 2021. The next opportunity is through NACO, the National Association of Counties, and that's Tuesday afternoon at 1 p.m. There'll be a webinar with 3+1 and the comptroller, Suffolk County Comptroller John Kennedy Jr. And they'll be talking. It will be a little bit like this, only some different stories and a different take from the Suffolk County perspective. So for additional information, you can tune into that. That's if you go on to NACO's website and Google webinars or Google 3+1, that webinar will come up and you can register there. And the other opportunity is a recording that we did between Joe Rulson, the president of 3+1, and Stephen Aquario, the NYSAC executive director, talking about financial prospects, the forecast for 2021, and that's available on NYSAC TV. That's YouTube, NYSAC TV, and that video is on there. We appreciate your time and we appreciate you attending the first webinar, NYSAC webinar in 2021. Thank you all. Stay healthy. Happy New Year. Enjoy the rest of your day.